Buying a business can change your life, but it can also go very wrong if you aren't careful. In this video, I'll share 7 biggest mistakes, or the 7 biggest mistakes buyers can make when acquiring a business. If you avoid these, you'll not only protect your investment, but you will maximize your chances of long-term success. So stick with me, and I promise you'll walk away knowing exactly what to avoid when buying a small business. Hi, my name's Trent Lee. I've sold over 600 businesses, and for the last 6 years in a row, I've been named the #1 business broker in the entire country for the most closed transactions per year. I make these videos so that one day you'll think about hiring me if you're looking at buying or selling a video. Mistake number 1, failing to perform proper due diligence. Rushing to close without a deep understanding of the business's operations, financial health, liabilities can cost you big time. Imagine buying a business with $500,000 in revenue only to find out that 40% of the income comes from a single customer. If that customer leaves you, almost half of your revenue is gone. So, what do you need to do instead? Review 3 to 5 years tax returns and financials. Check for customer concentration to see if there's too much risk or there's one customer or vendor that relies too heavily on this particular business. Make sure that the cash flow is healthy and analyzed by accountants. Look at the accounts payable, the receivables. In short, work with a due diligence expert, a CPA, or someone that can help you through that process to make sure you're buying a healthy business. Mistake number 2, overestimating the business value. Many buyers overpay because they rely on the seller's provided information and don't use proper valuation methodologies. Let's say a business generates $150,000 of seller's discretionary earnings. SDE is what you'll see online. Using a 3x multiplier, the business is worth $450,000. But what if you offer $600,000? You're overpaying by $150,000, money that could have gone towards improvements and working capital. So here's a pro tip for you. Don't just rely on a multiple of SDE. Use a multiple of course, SDE as one benchmark, but also make sure you calculate EBITDA. Use a different multiple for the EBITDA figure. And look at sales comparables. Research industry multiples and confirm that the asking price is fair and that it fits within the SBA debt service coverage ratio guidelines. Even if you're not buying this with an SBA loan, that's a good benchmark to make sure you're not overpaying and loading yourself up with too much debt. Mistake number 3, ignoring working capital needs. This is a big one. Even profitable businesses need working capital. For example, if a business brings in $100,000 a month, but it takes 45 days to collect customer payments, you'll need at least $150,000 to cover that gap. Many buyers overlook this and find themselves scrambling for cash right after they take over because there's a delay in payments. So, how to avoid this mistake? Make sure you understand the cash flow conversion cycle and plan accordingly. Secure a line of credit or aside cash reserves before you close on the transaction. If you're using an SBA loan, they will often help you provide this working capital. Just make sure you calculate it and know what you're getting into. Mistake number 4, not planning for a proper transition and staff retention. If key employees leave or clients lose trust during the business transition, the business can suffer or even collapse. I've seen buyers skip this step and struggle because they didn't retain the seller's knowledge and the key staff. So, what do? Negotiate a 3 to 6 month transition period with the seller. You can offer retention bonuses to keep key employees on board. You can meet with the employees and the clients early, right after closing, to establish trust. Mistake number 5, understanding SBA financing requirements. SBA loans are attractive, but the process is strict. For example, if you're buying a business for $500,000, you'll need typically at least a 10% down payment, and that needs to be at least in a debt service coverage ratio above 1.25 at a minimum. Most banks are going closer to 1.3 or above. So, what can you do? Make sure you run the numbers and you understand how debt service coverage ratios are calculated. Make sure that the business is pre-approved and you get an SBA lender to help you go through that process and make sure that you're not overcommitting to paying too much and then you're strapped with too much debt because the business can't handle it and you've overpaid for the business. One of the best things you can do as a buyer is get pre-qualified with an SBA lender prior to ever going out and even submitting an offer on a business. So prepare and know what you're getting into. You could be making the best decision of your life by buying the right business. If on the flip side you're considering selling a business, the first step is to find out how much the business is worth and how long it would take to sell. So I'll make this as simple as possible. As a business appraiser, I'll do a free business valuation and a market assessment to tell you exactly what the fair market value of the business is and how long it will take to find a buyer. And here's the best part. I'll never ask you for a penny up front. I only get paid if and when I find you a buyer and you're happy with the offer and we close the deal. There's zero risk to you. So use the link in the description to reach out to me, and I look forward to helping you either buy or sell a business. Take care.